Hello and welcome to the channel, where we break down the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're diving deep into a name that recently popped up on our screeners, BIYA International Group Inc., trading under the ticker BIYA. This isn't a stock we usually cover, but its recent activity and unique characteristics make it a prime candidate for our educational series. We'll unpack exactly what's happening with BIYA's borrow rates, its recent reverse split, and what these factors could mean for its future volatility. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight to it. BIYA International Group Inc., or BIYA, operates in the technology and software application sector. Through its subsidiaries, BIYA provides essential job matching, entrusted recruitment, project outsourcing, and labor dispatching services to businesses and organizations in China. They also handle human resource management, payroll, and electronic contracts. Currently, BIYA holds a market capitalization of about $88.03 million, placing it firmly in the microcap category. Looking at its recent performance, BIYA has had a tough time. Today it's down 11.97%, over the last 5 days it's dropped 6.93%, and in the last 30 days it's seen a significant decrease of 61.76%. Show chart of BIYA price action, highlighting 1 day 5 DAY 30 DAY volume has also been notably low, with today's volume at 1,829,200 shares, which is only about 0.3 times its 30-day average of 5,740,829 shares. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow? When traders want to short sell a stock, they first need to borrow shares from a broker. The fee they pay for borrowing these shares is called the cost to borrow, or CTB. This fee is often expressed as an annualized percentage. When a stock becomes hard to borrow, it means there are very few shares available for short sellers to lend, and demand to borrow those shares is high. Consequently, the cost to borrow skyrockets. Why can it exceed 100%? Imagine an annual interest rate of 779.7% on a loan. It's incredibly expensive, indicating extreme scarcity and demand. For short sellers, this high fee eats into their potential profits and can make holding a short position very costly. Why this stock is hard to borrow right now. Now, let's talk about why BIYA International Group Inc. BIYA is on our hard to borrow screener. The annualized cost to borrow fee for BIYA currently stands a staggering 779.7%. This is an exceptionally high number and a strong indicator of how difficult and expensive it is to short BIYA shares right now. While we don't have data on the CTB momentum or the exact number of shares currently available to borrow, we do know that BIYA has an estimated float of only 2.7 million shares. High float size. A small float means fewer shares are publicly available for trading, making it easier for demand, even small demand, to have a significant impact on borrow availability and price. Our internal composite squeeze score for BIYA, which combines factors like CTB level, float size, and price momentum, is 51.1 out of 100. Squeeze mechanics explained. So, how does a high cost to borrow relate to a short squeeze? A short squeeze occurs when a stock's price rapidly increases, forcing short sellers who bet against the stock to buy back shares to cover their positions and limit losses. This buying action further pushes the price up, creating a cascading effect. With BIYA's exceptionally high CTB of 779.7%, short sellers are paying a hefty premium every single day they hold their positions. If the stock price starts to move against them, even slightly, or if the available shares to borrow completely dry up, these high fees can become unbearable. This pressure can compel short sellers to close out their positions by buying shares back, which, especially with BIYA's small 2.7 million share float, could ignite significant upward price momentum. However, it's crucial to remember that high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction in their bearish thesis and are willing to pay those exorbitant fees to stay short. Dilution risk check. When evaluating any potential short squeeze candidate, checking for dilution risk is paramount. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the value of existing shares and can completely negate any short squeeze thesis, even with high cost to borrow fees, because the new shares can be used to cover short positions or simply flood the market. For BIYA International Group Inc., we found no recent dilutive SEC filings such as SNINUS 1, SMINUS 3, or 424B within the last 90 days. This is generally a positive sign, as it removes one significant headwind that could otherwise cap upside potential from a short squeeze. Recent reverse split watch. Now let's talk about another critical recent event for BIYA, or reverse stock split. BIYA International Group Inc. executed a 1-4-10 reverse stock split just 8 days ago, on July 13, 2026. Highlight date: reverse split reduces the total number of outstanding shares and, consequently, the float size, while simultaneously increasing the share price proportionally. For example, if you own 10 shares at $1 each, after a 1-4-10 reverse split, you'd own 1 share at $10. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. This isn't a guaranteed outcome, but it's a pattern that has been observed in some names as the market digests the new share structure and price point. For BIYA, this recent reverse split means a smaller float to begin with, which could amplify price movements if interest picks up. Once again, before we continue, a quick reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For BIYA International Group Inc., BIYA, here's what to keep an eye on. Given the 779.7% cost to borrow, any sustained buying pressure or positive news could create significant stress for short sellers. Highlight CTB watch for an increase in trading volume, especially if it breaks above the 30-day average of 5.7 million shares. A decreasing supply of borrowable shares would also be a key indicator, as would a sustained positive price momentum. Remember, the recent reverse split could lead to increased volatility in the coming weeks, so monitor price action carefully. However, with the current negative price trend and low relative volume, any upward movement would need strong conviction to overcome existing selling pressure. BIYA International Group Inc. BIYA presents a fascinating case study in the world of hard-to-borrow stocks, especially with its recent reverse split and incredibly high 779.7% cost-to-borrow fee. While the underlying business in China's human resources sector provides essential services, its microcap status and recent price action mean it's a stock primarily for those who understand high-risk, high-reward scenarios and the unique dynamics of short squeeze potential. Always remember to do your own thorough due diligence. If you found this breakdown of BIYA valuable, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments if there are any other hard-to-borrow stocks you want us to investigate next. Thanks for watching, and we'll see you in the next one.